With the bonds thing, you're saying that they're now sexy. How do people know when they're not sexy again? Is it solely just interest rates are going up, so the returns on bonds are going up? If interest rate starts coming down, the return on bonds will go down.
It's not that simple, because there's an extra dimension with bonds, which is the time that you lock in the rates, which are fixed. Okay, so if interest rates are increasing, you want short duration. These instruments pick up the higher interest rates really quickly, and they don't lose value as much if yields increase. Whereas long duration bonds get completely slaughtered. So in 2022, those long duration gilt funds lost more than they've ever lost, ever. Even if you can do back tests that go back 100 years and simulate them, there's never been a worse fall. So that's long duration is not what you want if rates are increasing. You don't want to lock in the rate for a long period of time. But when rates are falling, so let's just think forwards now to something like, I don't know, 1 year, 2 years from now, inflation's going to be falling. Rates will also be falling because it's likely the Bank of England is going to be cutting the short-term interest rates. And if that's the case, you want to lock in those high rates for longer. So suddenly having long duration makes sense. So
it's similar to a mortgage in a way, how people might think about the interest rates on their mortgage.
Yeah, because
it might be a comparable, like, should I fix it? Is it variable?
Except you're taking the other side of the trade this time around. So if you're receiving income, what you want to do is to lock that in for as long as possible if you think rates are falling. So that's what people will probably do. Certainly the pensioncrafters are going to do.
So you would go longer on the current rates to lock them in because you think they're probably approaching the peak.
So instead of a money market fund, which almost immediately pick up the lower interest rates, you'd buy a 10-year bond, a 20-year bond, because once you buy one, the coupon's fixed forever for the life of the bond. So that's why they become more attractive. So that's what you'd buy. And, so it really depends on what you think is going to happen to interest rates and how your thoughts are different from what the market thinks.
If people don't want to have that decision though, because like a lot of people, we're telling people buy a global index, so you don't have to think about it. And then when you talk about bonds, you predicting interest rates basically.
You do have to think about it. Yeah. So you do have to have some kind of view. But for other people, like let's say that you want to retire, okay, and then you want to buy a car every 5 years and you want to go on a holiday at this point in time and your daughter's going to get married in a year's time. Okay, so all of these events have cash flows that go with them. Wouldn't it be great if you had something where the money would pay out just in time? You'd know to the penny, to the day, how much you're going to get paid. Oh, that's a government bond.
Yeah.
So let's say that it's got a 5% yield. You only have to put 95 pence in for every pound that you receive. So my daughter's wedding's going to cost, I don't know, how much do they cost now? 30 grand? I don't know. You'd only have to put in 95 pence on the pound if the yield is 5%.
Yeah.
As long as you know when it's going to occur, you can plan almost perfectly.
And you can get that guaranteed return.
Yeah.
Yeah.
So I think for those planning purposes, it's really useful. And everyone has those. If you're young, you still have to plan for this stuff. Yeah. You want to buy a fancy car, you want to buy a house, all of this stuff you can plan for. So I think that certainty is invaluable.
Yeah.
Because with stocks, you don't know what's going to happen. It's so uncertain. You don't know what cash flows you're going to get. You don't know what it's going to be worth. It could crash just as you need it. And that uncertainty is a real problem.
And a certain 5-6% return is quite a nice return, isn't it? Especially if you're saying I need that in 2 years and that's money to get married with or whatever. So, that frame it in that sense from a portfolio allocation of see the bonds as a sure return and maybe set it towards a shorter term goal that I need in the future. Maybe you don't need to be predicting interest rates. You just go in, I want 5% on my 10K in 2 years.
And there's no prediction involved.
Yeah.
So when I did buy a single gilt I think it was in March, and I bought an inflation-linked bond as well, just to show the investors in our community how to do it. And I learned a lot from it. The link has been a wild ride, but the government bond, I know exactly how much I'm going to be paid. And that certainty has been so valuable.
I saw the process of you going through it. It was like you had to send smoke signals basically, didn't you? It was very antiquated. Like you got a piece of paper and stuff.
And this poor lady at the other end of the phone, she had to read out all of the stuff about the trade.
You know, I was like, I couldn't follow it. Like I watched that video. It was really, it just shows how archaic that kind of process is.
But I was just listening out for a certain phrase, which you was going to say, which was dirty price. I knew what the dirty price should have been.
Dirty price.
That sounds interesting.
I thought you'd like
it. Dirty price. Tell me more about this dirty price. What do you get for this dirty price?
There's more where this came from. Click here to watch the full interview with Ramin and Nakisa from Pensioncraft.